All right, thank you, Julie. Well, time now for this week's Money Monday segment. Financial and tax attorney M Zell is here with more on some common mistakes and pitfalls when it comes to buying life insurance. Thanks so much for coming in today. We do appreciate it. You know, there's a lot of people that may have life insurance, or the people that don't have it either, that maybe this is really important for them to hear these tips, because you think, where do I start? But I guess the biggest thing that people, maybe misconception, is that all life insurance is tax-free, but that's not necessarily the case.
That's right. I wrote an article in last week's, or this week's Washington Business Journal that focuses on some of the more common mistakes. And one of the biggest mistakes that people make is that while income tax may exempt life insurance proceeds may be subject to death tax. So, you know, $1 million term insurance policy or a $2 million whole life policy will be included in your estate when you die if you're the owner or have any incidents of ownership over the policy.
And that's, as well, you just mentioned, insured has incidents of ownership. What does that mean exactly? And, you know, help us out a little bit with that. Incidents
of ownership or any kind of ownership rights, such as the ability to change a beneficiary on the policy, or the ability to borrow against the insurance to finance any of your needs, or to pledge the insurance policy as collateral for a loan. Those are the types of incidents of ownership that, if you have those ownership rights, it's going to be included in your estate.
Okay.
So what a lot of people do is they try to structure insurance trusts to take the insurance proceeds outside of their estate, their spouse's estate, for estate tax purposes. Now this year, there's no estate tax.
Right.
But it's coming back. By the end of this year, the estate tax will be reenacted. And in D.C. and Maryland, there still is a death tax. So this is a very relevant and important topic.
Sure, absolutely. The other thing, too, having kids own the policy, that may not be the best decision. Why?
Well, you know, you can transfer the ownership of the policy to your children, and that'll get it out of your estate for estate tax purposes. But then you lose control over the policy. The kids can then borrow against the policy, change the beneficiaries, and gain access to the insurance proceeds, maybe for a purpose that you weren't really thinking about. And so if you lose control over the policy, that may not be the best thing for you in terms of your estate planning.
Yeah, be careful with the kids on that. Better make sure they have the best intentions there. Right. Insurance trusts as well, they need care and attention. It's not something you just get and then, oh, it'll take care of itself. What kind of care and attention does it need? How do you need to make sure it's maintained?
That's a great question. Every year, when you make the insurance premium payment, you shouldn't be paying the premium directly to the insurance company. Instead, you should be paying the premium to your insurance trustee. Your trustee has to give notice to the beneficiaries so that it qualifies for the annual gift tax exclusion. And then the trustee, after the premiums have cured for 30 or 60 days, can make a premium payment to the insurance company, and it qualifies for the annual gift tax exclusion, which is $13,000 per donee per year. So it's a significant and important benefit, and by operating the trust correctly, it takes the insurance proceeds out of your estate permanently. Okay.
Well, M Zell, we do appreciate you coming in this morning.
Thanks for having me.
And again, it's in the Washington Business Journal, but we also have a link to M Zell law at myfoxdc.com, so you can get a look at this information a little closer up there as well. Allison?
Thanks, Sarah.